Hi, this is Steve Gorin, and welcome to today's webinar, Using Trust to Avoid OBBBA Limits and Bequest a Business to Charity. Before we begin, I want to cover a few housekeeping items. If you have any questions during the webcast, you can submit them to the Q&A widget. I'll try to answer these during the webcast, but if a more complete answer is needed or we run out of time, it will be answered later via email. And actually, I would prefer you to just go ahead and email me directly if you want to get that answered. A copy of today's slide deck, as well as the most recent version of my current business succession materials, are available in the resource widget. We encourage you to download any resources or links that you may find useful. You can find additional answers to some common technical issues located in the help widget. If you experience any technical problems during the webinar, these can also be reported through the Q&A widget. Today's presentation is CLE accredited in California, Illinois, and Texas for 1.5 hours of general credit, and Missouri for 1.8 hours of general credit, and New York for 1.5 hours of professional practice credit for experienced and transitional attorneys. So any CPAs who want CPE, this is not the webinar to attend for CPE. I have a presentation doing the same things for CPA Academy on February 10th. So please go and check out my CPA Academy webpage. And there's a link in the final slide here. And there's also a link in the program announcement. We will award CLE based on attendance for the entire 90 minutes. As required, we will display secret words in 3 multiple choice polls during the presentation. You'll be required to select today's secret words from a multiple choice list. Please respond to those polls to demonstrate your continued engagement and to earn your full CLE credit. We value your opinions and appreciate your participation in this course. All right, so down to business. So income tax sensitive benefits have become more important under the 2026 HR 1, which was originally called the One Big Beautiful Bill Act. And the Senate parliamentarian actually stripped it of that name. And so it's more technically correct. And that's actually, I'm sorry, that's 2025 HR 1. And so it's more technically correct to just to call it 2025 HR 1. But other people have different names for the One Big Beautiful Bill Act, and I'm going to repeat another name in a little bit. We're going to talk about the fact that income sensitive tax benefits are more and more present in the first 2 segments: non-grantor trust to hold partnership interest, which will actually compose the first, or comprise about the first half of this webinar. And then we'll talk about trapping income and trust, notwithstanding distributions. And then we're going to go to a totally different topic on the bequest of business to charity. And we'll get into those details when we get there. All right, so materials. So you have the slides, newsletter articles, and a several thousand page PDF. So the newsletter that first came out, I've updated some things in there. So I encourage you to go ahead and use the big PDF that's attached in your widgets here instead of what was in that newsletter. And also, if you looked at the articles before yesterday, to go ahead and look at those again, because I've made a couple of changes there. All right, there's how to navigate between slides in the big PDF. I encourage you not to do that. We have an action-packed webinar, and I'm going to be moving pretty quickly. Okay, so we're going to talk about non-grantor trust to hold partnership interests. And I'm focusing on partnerships here because if you have an S Corp, then generally you need to either be a QSST or an ESBT, and we're going to talk about that in a little bit. And those don't really have the same planning opportunities for the most part that we have with partnerships. So partnership owners can use non-grantor trusts to maximize their qualified business income, to shift income, to obtain other tax benefits. This, by the way, this is all subject to the multiple trust rules, which can combine trust into single trust in certain situations. And by the way, on this slide, you'll see in the title bar, there's that 2J11 in parentheses, and then in that first sentence, there's 2J9C. Those are all references to the big PDF. All right, so additional benefits of non-grantor trust to hold partnership interests are multiple applications of taxable income threshold amount. This is the 20% qualified business income deduction. And if your taxable income is above certain thresholds, then there's a disallowance for what they call specified service, trades, or business. So that's people who are engaged in evil professions like ours. And it's also, you need to have certain wage base or depreciable property base in order to get the full benefit. If you're below these threshold amounts, then you get the full 20% benefit regardless of wages, and even if you are an evil business. So if you do have, the non-grantor trust, you could have, the trust has its threshold amount it can use, and it's got, and then the beneficiary has their own threshold amount that they can use. So if you can keep both below those thresholds, you can get the full benefits. And I've got some supporting materials that kind of talks about using trust to split income. Also, you can get multiple applications of the caps on state and local income tax or property tax. And now notice that that's not quite as important now as it was when we first had the 20% deduction for qualified business income introduced, because now a lot of states have a business level deduction that you can make through this pass-through entity tax. And this webinar is relatively advanced, so you really do need to have a basic knowledge of some pass-through business income tax to really be able to follow it. But I've got materials in there that you go through all of this stuff, so you can go research everything. Self-employment taxes. Well, the self-employment tax rate is 15.3% for up to the taxable wage base, which is around 170 grand or so. Above that, up to 250. For a married couple, it would be 2.9% per person, and then up to 250 per person for the married couple, and then above that is 3.8%. So this applies to self-employment income, which is generally going to be income from any business that a partnership conducts other than long-term rental of real estate. Now, the tax court, by ignoring legislative history, has undermined the exclusion from self-employment tax that applies to limited partners' distributive shares. The statute and legislative history say that you can be, they kind of imply you can be a general partner and a limited partner, and your general partner income will be subject to self-employment tax, and your limited partner income will not be. The tax court chose to disregard that legislative history, and just within the past week or two was reversed by the Fifth Circuit Court of Appeals in the Sirius case, SIRIUS. That is not yet in my materials. It'll be there when I do the next quarter. But again, this applies just to the Fifth Circuit So when you're not in the Fifth Circuit, you still have big problems on using the limited partner exemption to save self-employment tax, unless you're willing to go to the mat and then try to get it going to the to your Court of Appeals and hope you get the same result as the Fifth Circuit, which you should, but who knows what a court's going to do. In any event, self-employment tax does not apply to a non-grantor trust. We're going to talk later about how to get a business into a non-grantor trust, but the bottom line is, if your client's doing business as an individual, then through their LLC, then they may very well be subject to self-employment tax regardless of what they set up. On the other hand, if a non-grantor trust for their benefit owns their LLC interest, then they will not be subject to self-employment tax. And we'll talk a little bit more about that issue, about partnerships and in terms of the employee versus partner concept in another moment. So I did already mention income shifting between the trust and beneficiaries, and here's just the next couple of slides have some adverse consequences to increasing a beneficiary's adjusted gross income. So it could reduce itemized deductions, including the tradable income tax deduction and the 237th reduction of itemized deductions, which under Code Section 68, which used to be called the P's limitation. But this has come in full force. I mentioned it already in one of my prior webinars, how this works. And we'll talk about that a little bit in a moment. But I guess one of the big concerns with doing this non-grantor trust strategy, just because the strategy can achieve a lot of good things doesn't mean it's a perfect strategy. Hardly anything ever is a perfect strategy. And one of the issues with the non-grantor trust is if you're making the distribution to the beneficiary and you have your distribution deduction that will carry out the income to the beneficiary instead of taxing the trust, if the literal language of Code Section 68 would indicate that the distribution deduction is subject to that 237th disallowance, which can result in double taxation because the trust gets deemed for that 237th disallowance. And then when the beneficiary gets the K1, then they could have a 237th disallowance based on their taxable income that's increased by that K1. I led a task force for ACTEC that had a lot of very talented members in it. And we made comments to the government, both to the IRS and Treasury as the regulators on the one hand, and the Congress as the statutory source on the other, about this and point out this is double taxation. And we're hoping that they'll fix it. At Heckerling, it seems like the speakers were assuming this is a fait accompli, and they're assuming that the Treasury will not fix it and that it requires a statutory change, and that who knows whether the Treasury will fix it or not, and they don't trust the government to fix it. But I don't really know what's going to happen. I'm not going to be optimistic or pessimistic about it. This is just kind of a warning that this might apply. And when you're doing planning for 2026, which is the first year to which it applies, then you need to take that into account with your clients. So this idea of putting it into non-grantor trust, putting a partnership interest in non-grantor trust does have that disadvantage to it. By the way, I do want to do a little shout out here. My whole inspiration for doing this is that ACTEC fellow Gray Edmondson, who does a wonderful job of keeping up with federal income tax of businesses and state income tax of benefits. In fact, he's even more attuned to the state income tax of businesses than I am. Was kind of what was kind of going through, what does he think some of these are, and then what my opinions were. So he was my inspiration for this, and we kind of discussed back and forth on this. So he gets credit for my deciding to seize upon this topic, but he doesn't get any blame for anything I leave out here. Okay, so the increasing the benefits adjusted gross income may also cause the AMT exemption to be phased out, cause the personal exemption to be phased out, increase the 3.8% net investment income tax threshold, increase Medicare premiums, adversely affect college financial aid on the FAFSA form, and probably other things I haven't even mentioned. So the idea here is that at least we have an opportunity to split the income between the trust and beneficiaries, maybe even trap it inside the trust. And we're talking the second segment about trapping it inside the trust. But the idea here is that here's some disadvantages for the beneficiary having that gross income, and perhaps splitting it up can help out with some of these issues. Today's first secret word is act. Please select the correct word below. Again, act is the first secret word. Okay. I haven't had any substantive questions yet. And before I move on to the next slide, I'll let you answer it for another moment. I'll just mention what's on the next slide. Oh, here we go. Now we do. We have 75%, a little bit more. I'll just wait for that. But we're going to talk how to get the partnership interest into the trust now, which will help out. Before I do that, I had one more. I had a little bit more poll, another more to go before doing that. All right. So non-grantor trusts can hold that hold partnership interest. They can get multiple capital gain exclusions under the code section 1202 exclusion. So there's a qualified small business stock. Cutting the other way is we don't have the flexibility for S corp planning within non-grantor trusts. And I'll talk a little bit about QSSTs and ESBTs later, but here's a little reference to that. Generally, trusts get higher charitable deductions for cash donations than do individuals, but they can't deduct unrealized appreciation on property. So, trusts have the code section 642 parentheses C deduction 100% of the trust gross income, but code section 681 says you don't get that 100% deduction from income against your unrelated business taxable income, and instead you apply the individual limits under code section 170 when you have unrelated business income. Unrelated business income includes any S corp K1 income, and it includes income from a partnership to the extent that it comes from a trade or business. And in many ways, a lot of the unrelated business income kind of parallels the self-employment income idea. And sometimes it's helpful to even look at each for context. Trust also, when you have the 642C deduction, when you don't have the unrealized business income, you cannot deduct unrealized appreciation on property. The 100% deduction requires, first of all, generally that the trust authorize the distribution of charity, although that's not required for a charitable contribution that passes through on a K1 from a pass-through entity. And it also requires that the contribution be made out of gross income. Now, the rules that have evolved don't require an actual tracing of the gross income to the charitable contribution, but they do require that it be plausible that the gross income was used to make the contribution. So if you have a marketable security that you're donating, and it has unrealized appreciation, well, that unrealized appreciation obviously was not acquired by gross income. That unrealized appreciation has not been realized, so it's not gross income. And even the basis of the property, did the trust buy that property? Did it buy that property after it had gross income? Maybe the trust was funded with that property. So none of the trust gross income was used to buy that property. So donating appreciated marketable securities is very dicey when you have a regular trust. On the other hand, if you have unrelated business income and you're applying the 170 rules, then the 170 rules allow you to deduct the fair market value with an unrealized appreciation. You don't have to get into all this out of gross income issue or the authorized by the trust agreement issue either. So the big difference, I would say, so both the regular charitable deduction, trust deduction, and the individual deduction, both of those have the 2/37th disallowance going with them. But the individual deduction has a 0.5% of adjusted gross income subtraction from your aggregate charitable deductions, and it also limits the percentage of adjusted gross income you can deduct your contributions against. So those individual limits can be, not so helpful. So it all depends. All right, contributing a business interest to charity involves many issues. I'm not going to get into all of them now. I will talk about the partial interest rules a little bit later when we get to the third segment. And here's the issue of if you didn't have a partnership interest and you had an electing small business trust, then again, automatically you get to apply the individual rules to that. All right, let's talk a little bit more about estate planning strategy with non-grantor trusts. So grantor trusts can save estate tax by the income tax burn off of the deemed owner's income. Now that burn off isn't as great when you have the passive entity tax. Another benefit to a grantor trust is you can avoid loss basis step up at the grantor's death by swapping assets, and you can't do that with a non-grantor trust. It's a taxable exchange. On the other hand, if the grantor is under the estate tax threshold, the grantor doesn't care about this burn off. In fact, the grantor doesn't want to have anything to do with the income tax burn off. So estate tax is not a detriment, but I would say that the inability to swap assets with the grantor tax-free and move low basis assets from the trust back to the grantor and have the grantor transfer high basis assets in exchange for that, that's an important thing to be concerned about losing. But Gray's point was, look, I'm looking at an income tax play for the beneficiary of this trust. How would it be relative to the person owning it outright? I mean, if the person owned it outright, they couldn't do a tax-free swap with their parent anyway. So the point here is that we're just looking at an individual client or a client's child and looking for ways that they can save tax. We're not going to maximize estate tax benefits here. this is not driven at all by the estate tax benefits, or we'd be looking more toward the grantor trust, but this can be very, very valuable for just an income tax play. Now, non-grantor trusts have more complex rules regarding participation to avoid the passive loss rules or net investment income tax, in addition to some other issues. So I have here some where you can, I point to my materials where you can find out about the passive loss rules generally, and about the tax on net investment income, and where you can find that. Additional non-grantor trust applications, you can just see some more additional issues that kind of go along with that. And I'm not going to go through all these different slides. We can go back and talk more if time permits. And if you want to put a question in the chat, then I can give that priority if time permits. But I'm really wanting to skip through here to the section that talks about net operating loss versus a suspended passive loss when being passive can be good. And I was just advising a new client about this on Saturday. And so this new client, actually there's two owners. One of them is in a top bracket and would love to deduct the any losses that may occur. The other one is in a modest bracket and from that person's perspective, yes, they would love to get the losses, but if their business really takes off, they're going to get pushed into a high bracket. And they would rather have those losses be put into, weighted to be deducted until they receive a ton of income. So for them, it would be better not to take the losses to begin with. Now we have different ways to deduct or not deduct losses. So the passive loss rules certainly can suspend the losses. Your basis can also limit the losses that you take. But and then there's something called the at-risk rules. But let's suppose you can take losses under all three of those rules and you generate a loss. And that loss, overwhelms your taxable income. So what's the consequence of that loss overwhelming your taxable income? Well, number one, it's going to offset income in the lowest brackets, and instead of being able to save it for the higher brackets. Number two, the 2017 tax law changes say that if you have a net operating loss, you cannot deduct it in full against all of your future taxable income. It's limited to like 80% of your taxable income. So you may have these net operating losses and you might not be able to take them in full as soon as they're helpful, because you have this limitation. So think about if you can find a way to prevent your losses from being deductible when you're in a modest or low tax bracket year, and suspend that loss until you're in a high bracket year, you can use that loss in full and you don't have that net operating loss limitation that was introduced by the 2017 tax law. So you can use the passive loss rules, and have a trustee who's not involved in the business with a non-grantor trust, or you can do, have a basis suspend those losses, or you can see if that risk rules can suspend those losses. So we do have several different ways to do it, but having a non-grantor trust might facilitate being able to have these losses suspended so that they don't generate a net operating loss, and you just take them into account only when you really need them. Allocating depreciation to beneficiaries, it's a pretty weird, counterintuitive thing. When normally when you have a trust that owns an interest in like a partnership, that trust is going to pass through depreciation deductions to the beneficiaries who receive the income from the business. And that depreciation can even exceed the income from the business. And the beneficiary can personally receive that depreciation deduction. There are ways to avoid that if that's not helpful. But then the question is, what is the character of that depreciation deduction? Do you base it on the trustee's participation in the business or on the beneficiary's participation in the business? And it's not totally clear what the answer is. But I have certainly advised a client to take a multi-million-dollar depreciation deduction when the beneficiary was active in the business and the trustee was not. Of course, I didn't tell them that it was, totally safe, but I think that they do have substantial authority for doing that. So I was happy to pass along that information to them and let our tax preparers make their own decision. Making the beneficial owner not be a partner provides better fringe benefits because partners and 2% S Corp owners don't get the full benefit of certain fringe benefits. It does require the beneficial owner, who is an employee rather than a partner, to need to take care to get expenses reimbursed, because unreimbursed business expenses for an employee are not deductible, whereas unreimbursed partnership expenses for a partner are deductible. Making the beneficial owner not be a partner can also, that would generate wages to that beneficial owner and support the 20% deduction for qualified business income. If a partner receives salary, that is taxed as a guaranteed payment, which is neither qualified business income nor wages. So if you're going to pay salary, paying it to an employee is definitely a better way to go than giving them a guaranteed payment. Guaranteed payment, it sounds like it's something that's actually guaranteed. It can be variable. A guaranteed payment is simply compensation a partner receives that's not based on the net income of the partnership. All right, so a brief recap of advantages of non-grantor trust holding partnership interest. You can avoid self-employment tax. You can get multiple applications of the qualified business income threshold amount. A non-resident trust also might save income tax on the sale of a partnership interest. My materials go into detail on that. And I thank Gray for sensitizing me to that. He did that not even just recently, he did that a couple of years ago. Non-grantor trusts can cause extra tax as well, so be sure to consider all the factors. So today's second secret word is trust. So please select the correct word below. Again, trust. While running the poll, I will start talking about how to get the partnership interest into trust. And we preferably would do this when we're starting up a business. So we could have the client's parent create a non-grantor trust for the client, and then the non-grantor trust could borrow money to go ahead and start up the business. And I'm going to move on to that slide because 78% have answered that poll, 79% now. Okay. So this could be for a new partnership to start a business, or if you have an existing business, maybe you have the next location or the next line of business be in a separate LLC or other business entity taxed as a partnership, another LLC in a separate business entity, and have that that entity that might be minimally capitalized from that small gift that the client's parents used to put into that trust. And then you might have the existing business loan money to the new LLC to be able to get the business started. And again, this could be a new business line or a new location or something else. Another thing that can be done is the client can form an incomplete gift non-grantor trust, or even a completed gift non-grantor trust. The incomplete gift non-grantor trust, the IRS has stopped issuing private letter rulings on it. I've never been comfortable with the idea of those rulings that you can be an adverse party for grantor trust purposes and not for gift tax purposes. So that just kind of boggles my mind. So I'm not a fan of INGs. But you could do a non-grantor trust that's just a completed gift, but the client wouldn't really be able to be a beneficiary of that as a non-grantor trust. Whereas if you do the kind of the ING, well, I mean, you could have kind of the ING structure, but have enough to make it not be a grantor trust. But it's really tough because you have to have an adverse party whose consent is required to make distributions to the grantor, and I don't really think that you can fully count on the adverse party exception. You'll see my materials where I talk about adverse parties about that issue. Another way to you might have an existing business, and so what you could do is do a sale to an irrevocable grantor trust and then turn off the grantor trust powers. So that's another way. But again, for that one, the client wouldn't be the beneficiary, but the client's family could be. If the client has a parent with significant life expectancy, the client's parent could set up a beneficiary deemed to own trust. Some people will call it a BDIT, or beneficiary defective inheritors trust. That acronym, defective inheritors, doesn't make any sense to me. I like to just call it what it is, a beneficiary deemed to own trust. So you could do a sale to beneficiary deemed to own trust, and then once the sale is complete, you turn on the power to make the grantor be the deemed owner. When you do that, that shuts off the beneficiary being the deemed owner, and then the parent would quickly turn off the grantor trust power because the parent doesn't want to be taxed on the trust income. So that's a method, but it is risky because you're waiting for you're trying to make sure the parent will survive the time in which the business is paid for. So, so you just want to be, be cognizant of that, maybe get life insurance. I don't know. Okay, now I'm going to move on to a whole new topic, which is trapping income in the trust, notwithstanding distributions. Because we know that the normal trust rule is when a beneficiary receives a distribution, that carries out DNI, distributable net income, all the taxable and tax-exempt items, and you can't opt out of that. The beneficiary has to receive a K-1, and then the trust gets a corresponding deduction, again, subject to that 237th floor. And this is something which I was thinking of long before I saw this at Heckerling, but the speakers in Heckerling's current developments panel were saying, hey, we have this 237th disallowance on the distribution deduction, which is ridiculous double taxation. We have no assurance whatsoever that Congress will or the IRS will undo that. And so this is ridiculous double taxation. We want to avoid it. We want to avoid the distribution deduction. We would rather just trap the income inside the trust. So they do have a point there. But generally, I look at this as the beneficiary is already in the top federal bracket and would benefit from not having more income, due to the reductions in tax or other benefits that I described in the first segment of this. Another thing that would encourage you to do this is the trust is not subject to state income tax, but the beneficiary is. And in Missouri, our legislature said that Missouri resident trusts are taxed as non-resident trusts starting January 1st, 2026. So they would be taxed only on Missouri source business income or Missouri source rental. There may be other categories that they might be taxed on, but they definitely would not be taxed on income from a portfolio of marketable securities that you're just holding as an investor. So, and I've done this strategy with a beneficiary who was in the top bracket federal and it was a non-resident trust for the state in which the beneficiary was located. So we did this strategy, but there was a lot of money at stake. So I wouldn't willy-nilly do this. This is not like a regular go-to strategy that you want to always look at. You really have to be saving material money to make it worth the effort on this. So let's talk about how you do this. The trust contributes all of its asset to an S corporation that it forms. If there's more than one remainderman, then you form S corporations, like multiple S corporations. So like this particular client had 3 kids. So there were 3 separate S corps that were equal owners of one LLC. The LLC holds all the assets. The S corps hold the property, hold the LLC 1/3, 1/3, 1/3. And then the trust owns the 3 S corps. And that way, when the current primary beneficiary dies and the trust splits up, each of the 3 kids would get their own separate S corp. And that's because an S corp that just holds marketable securities cannot split up tax-free. So how does this work? So this is making an electing small business trust election. I don't think I mentioned this yet on the slides, but that's what we're doing. Is that the trust makes an electing small business trust election, and that means that the trust distributor share of the S corp income is taxed to the trust, notwithstanding any distributions to the beneficiary. Now, if the trust does not contribute all of its assets to the S corp, and the trust has some of its own investment income that's outside of that S corp, beneficiaries will cause those assets to be the income from those to be carried out to the beneficiary. So in that case, the question is, do you like that result or do you not like that result? If you don't like that result, then either consider putting all those marketable securities up to that trust, or consider splitting the trust and having those assets held in another trust, and that other trust would be accumulating the income and not making distributions. And again, we're not necessarily doing this to save federal income tax. We're doing it to save state income tax in many cases. So the multiple trust rule to save state income tax, that does not appear to be something that will cause the IRS to try to collapse the trusts. Now, the states could try to do that, but that's that separate accumulation trust is an idea that I'm using for one client, but another topic might be that you want to make contributions and of appreciated securities and get the full benefit of that. I'm sorry, the contributions of that wouldn't come from those assets inside the trust because it doesn't get the full deduction. The benefit of this is, as an ESBT, any contributions that are made to charity using are going to use the individual income tax rules, so you can deduct your appreciated marketable securities. When the S corp makes it, or if you have that other structure where I had the 3 S corps owning an LLC that holds all the assets, then when the LLC makes the contribution. The contributions must be less than substantially all of the S corporation's assets, or the S corp is deemed to liquidate, which will cause a taxation on all of the S corp's assets. All right, so I already mentioned about if the trust reinvests its distribution to taxable investments, then the trust should divide. Basically, what I do for this client who has that separate accumulation trust is, whenever there's a distribution coming from the S corp, which in my client's case is a business, it's an operating business that generates millions of dollars of income, and they make distributions usually each quarter plus a final year-end distribution. What we do is the trustee will save enough to pay income taxes, and then retain enough to make a distribution to the beneficiary, and then the rest of it is sent over to the separate accumulation trust. So in that case, the distributions again are made from a trust that has only the S corp K1 income, which is trapped by the ESBT election. All right. Okay, so I think I mentioned the third bullet point. Okay, so you want to make sure the S corp formation is non-taxable. If you just have one trust putting all of its assets into the S corp, that's not going to be taxable as long as you don't have liabilities that exceed the basis. I've already mentioned you can't divide tax-free. Distribution of any investments from the S corp to the trust would be taxed as a sale. So if you want to try to get a basis step up on those assets when the beneficiary dies, or you want to try to get those distributed to the beneficiary, so the beneficiary can get a basis step up on death. You don't want to have those assets inside the S Corp. You want to have them directly owned by the trust. Personal use assets inside the S Corp would require rental. I don't think that's a very good trade-off. So I would tend to keep any personal use assets outside of the S Corp. I already mentioned the solution to being unable to divide the S Corp on a tax-free basis. So let's move on. Distributions from the S Corp to the trust are what's trust accounting income. So it's not the K1 income, but it's rather the actual distribution. So let's suppose that the pass-through entity, we have an S Corp, boy, we can just talk about it there. So you have an S Corp, and it has 100x K1 and a 40x distribution. The distributable net income is 100x. The trust accounting income is 40x. Now, if you have a mandatory income trust, you need to keep that 40x in to be able to pay the income taxes, and you can't distribute it out. If you distribute it out, then you'd have 60x of taxable income and no way to pay the tax. So it is important for a mandatory income trust to be really cognizant that you don't distribute all the trust accounting income, you keep enough inside to pay the taxes. If the distributions are higher than is fair for the trust accounting income, then the trustee can do the exercise the power to adjust to reduce the income. And similarly, if distributions are lower than what would be a fair amount, distributions from the S Corp to the trust, then the trustee can exercise control over the S Corps. And if you have kind of the three S Corps owning the LLC in my example, so the trustee would really exercise control over the S Corps and the LLC to increase the distributions to a fair level. And if you have a mandatory income trust and distributions decrease after this S Corp strategy is adopted, the beneficiary may object to trustees not working hard to increase distributions. The beneficiary would probably have an uphill battle in arguing with the trustee over whether to exercise a power to adjust, and so that would reduce the likelihood of a taxable gift. I'm not saying this is perfect. I'm just trying to give you the best arguments. Okay, today's third secret word is principle. Please select the correct word below. Again, principle. And we have had a really quiet chat here. I've had no substantive questions so far. While you're answering the question, I'm going to discuss what we're going to be discussing in a moment. And this is the idea of a shark fin charitable lead trust, which I'll define in a minute. But we're going to talk about when you need to have a charitable lead trust, how long an estate or post-mortem revocable trust can hold stock in an S corporation, and also income tax issues before and after funding a testamentary charitable lead trust with a business interest. All right, we have 73% of attendees have already answered the poll. I'm going to go ahead and move on. Okay. So there's my introduction there. So some of the rules regarding charities and having deductions, here I'm talking about let's suppose we have a bequest, so we want to get we have a post-mortem distribution to charity, and we want to get a charitable deduction for that. The rules for charitable deductions prevent having what we call a partial interest to the charity. Now, some things are okay, like voting and non-voting stock. It's okay if you already have voting and non-voting stock to go ahead and give non-voting stock to charity without giving it the voting stock. Now, you wouldn't be able to post-mortem take your voting stock, split it into voting stock and non-voting stock, and give away the non-voting stock. So you have to have that arrangement already in place before you make that bequest, and you don't want to do like a step transaction. And we have other examples that I have in my materials. You can see the citation, cross-reference, and the first bullet point. Of course, a charitable lead trust or a charitable remainder trust is a definite possibility of who can get a charitable bequest. In my recent case I'm working on, we have an S corp, and so we can't have a charitable remainder trust own that stock. And the question is, what if the client says, look, I really care about this business. I don't want any charity coming in and mucking up how the business is run or how it gets sold. And the client does intend a post-mortem sale of the business to an unrelated third party, and then so that the family can cash out. So the client is kind of like, I want to sell the business. I don't want the charity to ever have to get stock. Just get the proceeds. Well, does that violate the charitable partial interest prohibition? I don't know. I'm unaware of anything that directly addresses that issue. On the other hand, we have something called a shark fin charitable lead trust. And let me go and talk about what a charitable lead trust is and what a shark fin charitable lead trust is. A charitable lead trust will have periodic payments to charities for a period of time or a life. And then at the end of the day, it passes to the client's family. So more typically, it's a charitable lead annuity trust where you take a percentage of the fair market value at death, and then you use that to determine the annual payments that go to charity. And so you have kind of fixed percentages in your estate plan. I should say set percentages in your estate plan, because we'll talk about how you can vary those. And then once the period of time ends, it goes to the kids, for example. If it's an annuity trust, you value it just once. If it's a unit trust, then every year you value the charitable lead trust and then apply the percentage. So the charitable lead annuity trust is easier to administer from that perspective. There is risk that the business might go down in value, and that you might not be able to pay off the whole charitable portion. A charitable lead unit trust doesn't have that issue, but it does require annual revaluations. The annuity trust will maximize the growth that can go to the family, the postmortem growth. On the other hand, it's a unit trust allows you to apply GST exemption to it and get the full amount that goes to family protected from GST, whereas an annuity trust, you take the GST exemption and increase it by the 75/20 rate, and then that's the amount that can pass. That determines the amount that can pass to the kids. So between an annuity trust and a unit trust, there are some countervailing risks to go with. How big, how much can you vary the annuity? Well, if you have a charitable remainder trust or a GRAT, which is modeled after charitable remainder trust, then your payments can increase from one year to the next by up to 20%. So year one, multiplied by 120%, that gets you to year two. Then for year three, you would take the year two annuity and multiply that by 120% to get the year three. So that's the maximum amount that you can increase your annuity under a GRAT or a charitable remainder trust, is do these annual 20% increases. For charitable lead trust, it's kind of open season. The IRS has provided model forms for charitable lead trusts that do not specify the relationship of the year one annuity to the year two annuity or to the year three annuity, etc. So you do need to have some amount paid every year, but some creative people thought of an idea called the shark fin trust. And what that is low payments in the initial years, and then a big payment in a later year. So figure out how long you can hold, and my example was the S Corp stock inside the trust or estate. And then once you do that, and hopefully the business is sold by then maybe you have your shark fin payment, and hopefully that would be by the time the business gets sold. You could have your higher payment be in a later year than that as well. And we'll run through some of the issues that go along with this when you do that. How much do you have to have in those initial years before you reach your big shark fin payment? The answer is nobody knows. So my advice is whatever charitable bequest the client has that can be paid using other assets, possibly business income, but a lot of times businesses distribute just enough to pay the income taxes, so there wouldn't be enough left over to pay the charities necessarily. So you want to just kind of model it out. So I'm kind of mentioned everything that's on this slide. So I mentioned this other slide. The third bullet point is who's going to receive the charitable lead trust distributions. If you have a variety of charities, then the trustee or executive or personal representative of the estate needs to be communicating with all these different parties, and they're going to be separately asking, where's my money, where's my money? Which is, again, I'll cite the movie Jerry Maguire, where Tom Cruise plays a sports agent whose sports agency connives and gets rid of and steals all his clients and leaves them with only one client. And that client just had one request, which was, show me the money. And that's what the charities are going to ask as well. If you have a donor advised fund or a private foundation, then the only person the trustee needs to account to is the donor advised fund or the private foundation. Now, I would definitely prefer to have a donor advised fund from an income tax viewpoint because you get a better deduction when you're making distributions to it. The IRS model charitable lead trust form allows charitable payments to be deferred until the charitable lead trust is funded. So if the revocable trust or estate has not sold the stock yet, then the trust simply doesn't fund the charitable lead trust yet with that stock, funds it with other things to make the annual payments. But if it doesn't even fund it at all, then that's still okay, because the charitable lead trust form says that you can defer payments until the charitable lead trust is funded, and the only consequence is the deferred payments will be increased using the code section 7520 rate. So this is a huge benefit that the charitable lead trust forms allow, and it gives us a lot more flexibility because you just hold on and then you fund it with cash whenever you're ready to make the distributions. So how long can the probate estate or qualified revocable trust hold on to that stock? So if the probate estate or qualified revocable trust holds on to that stock before transfer to charitable lead trust, and is deemed to pass from an estate, and a qualified revocable trust that makes a Code 6345 election is taxed as an estate. So if it gets this trust, the charitable lead trust can hold the stock for 2 years before making electing a small business trust election, and avoiding the ESBT election for as long as possible is critically important to maximizing charitable or other deductions. I already mentioned that to some extent, but we'll go into it a little bit further in a moment. So then when you make the 645 election, the revocable trust can hold the stock, stock. And now again, for a partnership, there's no limit quite as much. But you don't have to make any elections at all. So this is really more for S stock that I'm focusing on here. So it's a 6 years and 9 month period. The original issue of my newsletter says 6 years and 3 months. And my newsletter and articles have since been fixed, and what is available in the widget is fully updated for this to say 6 years and 9 months instead of 6 years and 3 months. So how do I get the 6 years and 9 months? So first of all, the estate tax return is due 9 months after date of death. You can extend that for 6 months. So that would be 1 year and 3 months. The code section 645 election expires 6 months after the 3-year statute of limitations expires. So you need to get a transcript rather than a closing letter. If a closing letter is received, then that will cut short the period that the 645 election can be in place. And the IRS issued a notice, it's in my materials, that says that getting a transcript online from the IRS is just as good as getting a closing letter from the IRS. I also don't like getting closing letters because of, if you're going to call the IRS, you need to talk to somebody, what a pain. If you simply file your Form 2848 power of attorney with the IRS, you can check online for a transcript whenever you want. You don't have to talk to anybody. You can get it done in a good 10 minutes. Or maybe if you have a series of clients you're doing it for, 5 minutes to log in and get ready, and then another maybe 2 or 3 minutes for every estate tax return you're doing for that. So I much prefer getting a transcript over the closing letter anyway. All right, so you've got 1 year, 3 months, then you have 6 months, and then you have 3 years. So that gets you up to 4 years and 9 months. And then after the 645 election expires, the qualified revocable trust can hold the stock for another 6 months. Another 2 years, for another 2 years. So because it's a testamentary trust. So that's kind of the deadline. So then what do you do with that? Well, the revocable trust can provide alternatives for whether the stock is sold within 6 years and 9 months. If it is sold within 6 years and 9 months, you transfer the proceeds directly to the charitable lead trust, and you want to do that whenever it gets sold. If not, the revocable trust would say that the stock is bequeathed to the estate, and the estate bequeaths to the charitable lead trust under the same terms as the revocable trust. So the money is going, the assets going to the charitable lead trust no matter what. It's just that the estate is your conduit for that. And then whether the trust or estate holds S stock, I would specifically direct distribution from the S corp be paid to the charitable lead trust. Okay, so what are the income tax issues? So we have the estate or trust would have a distribution deduction for payments made to the charitable lead trust. So each year as you receive your income from the S corp, you would transfer that to the charitable lead trust to the extent that you have distributions in excess of what you need to pay your taxes. But the trust distribution deduction, again, that's generally going to be 100% deduction, but you have that 2/37 disallowance that I mentioned from the Big Ugly Bill Act, or BUBBA, and so we want to avoid BUBBA here if we can, but that's a weakness in this strategy, is having the 2/37 disallowance, and hopefully that disallowance will be repealed, but we don't really know. So you'll get the money going to the charitable lead trust. It gets this K1 for 100% of what the distribution is typically. And then the charitable lead trust needs to take a deduction. So if you have an S corp, then that's all unrelated business taxable income. And so you can deduct cash up to 60% of the S corp K1 income. If it's a partnership, then you look to how much is unrelated business taxable income and how much is not. So you can deduct up to 60% of the UBTI and all of the non-UBTI. Now, when I say all, we still have the 2/37 disallowance, no matter which section we're deducting it under, 170 or 642C. And you have, if you have UBTI, then you have the individual limits applying, so that you also have the 0.5% of adjusted gross income reduction, and as well as that 60% cap. And again, this is assuming you have a public charity. The deduction is reduced if you have a private foundation. So after you make an ESBT election, though, the charitable deduction is not allowable against the S corp K1 income. With an ESBT, the only charitable deduction that you can get is a contribution that the S corp itself makes, not a contribution that the trust makes. So the ESBT is really where you get to the very worst tax situation. I'm going to cover my final slide here, and then I'm going to answer some questions from the chat, and then I'm going to. So if you have any more substantive questions, please go ahead and send them in, because I have plenty of time. And if you don't send in questions, then I'm just going to go back and add some more details for some of the things which I went through quickly. Okay, so the Heckerling Institute on Estate Planning, which is the largest one in the country, is attended by reporters from the American Bar Association's Real Property, Trust, and Estate Law section. Those reports are issued by ABA Ripity, and they're available free of charge. I also pass on those reports to ACTEC. So there's ways you can get those reports. The ABA reporters usually do a great job for that. What I do, I had forwarded those reports to some friends with some commentary, and one of them, who I respect extremely highly, said these are just wonderful. And so kind of like, okay, well, I'll just share them with people as well. So I have a separate email list for Heckerling reports. So my commentary, so you get the ABA reports, a link to the ABA reports, and you get my commentary on that. So you can sign up for those reports on Heckerling, and there's a link there. And that if you don't subscribe to my quarterly newsletter, then you can also subscribe to my quarterly newsletter that has my big PDF in there. So I encourage you to do that. I encourage you to save the date for my my next webinar, April 28th at noon Central Time, for my first quarter 2026 webinar. You see there's some other resources there. And then finally, there's a link to my CPA Academy instructor page. And you can, again, CPAs can get free CPE there if they're among the first 1,000 registrants. And believe me, that does get exceeded sometimes. And so you really want to sign up quickly if you're doing those. Okay, I had a question. Why not use a 20% increased charitable lead trust, since it is blessed by the IRS, but the shark fin is not, and the risk of losing that deduction can be huge? So that is a pretty decent comment. I think one of the big concerns that I have is pressure from the charities to make the distributions. And if your stock isn't sold, I mean, there's only so much you can go up by the 20% per year. And now, if you use the strategy I mentioned, where you might have an intervening donor advised fund, then that can kind of provide a buffer on it. I'll tell you that the donor advised fund idea, most national donor advised funds do not want to hold any closely held assets for more than a couple of years, and you have to have a plan to sell it, a non-binding plan, of course. But there are some nationally known donor advised funds that will allow you to hold that for longer. So you need to go out and find those. But I'm mainly just concerned about the pressure for the charity. But it would be a correct observation to point out that because the forms allow you to defer the actual payment of the charitable lead trust until it gets funded, that if you hold back the funding, then none of those payments get due right away. And so you can just defer those payments at the cost of the 75/20 rate, which is how you calculate your shark fin anyway. So that is a good point to consider. why not drop down the S Corp assets into a single member LLC and gift those LLC units to a charitable remainder trust? So this is the idea that you want to have the an S Corp and you want to sell it, and instead of selling your S shares instead of giving your S shares to a charitable remainder trust, you because you can't hold them in this charitable remainder trust, what you do is you do kind of a two-part step here. And the first part is you form a new S Corp, and that's a holding company that then and then the shareholders of the old S Corp contribute their shares to the new S Corp. That's called an F reorganization. That's code section 368, parentheses A, parentheses 1, parentheses capital F. And the new S Corp gets all the tax attributes of the old S Corp. You make an election to treat the old S Corp as a qualified subchapter S subsidiary, also abbreviated Q sub. That's a disregarded entity. The Q sub can then do a state law conversion into an LLC, which is also a disregarded entity. And there's no tax consequences to go from the Q sub to the single member LLC. And then you could contribute the LLC to the charitable remainder trust. The problem with that strategy is now the CRT has a wholly owned business that is generating business income. And all of the business income is subject to 100% tax at the CRT level. And when the CRT does make distributions to the beneficiaries, they also get taxed on that income. So you have a tax in excess of 100% for any unrelated business taxable income. Now, if the S Corp is unfortunate enough to hold real estate and the real estate doesn't have any debt on it, then long-term rental of that real estate would not be unrelated business taxable income, nor would the sale of that real estate be unrelated business taxable income. So that might be a CRT solution for that. If an S Corp does form an LLC and donate to charity, first of all, if it donates substantially all of its assets to charity, then that would be a deemed liquidation of the S Corp. So you want to make sure it's less than substantially all of the assets. I think substantially all of the assets are probably about 90 to 95%, but I don't know of any particular safe harbor on what that is. That's just my best guess. So you're at your, you take your own chances when you do that. So if you're doing less than substantially all of your assets going to this charity, to the single member LLC that goes to charity, and then you're not generating unrelated business taxable income, then that might be a viable approach. But I am far less than excited about doing that strategy. All right, so those are all the substantive questions that I've received so far. So now I'm going to go back and go over some other things because we do have 6 more minutes left, and I do want to make sure that everybody gets their continuing education credits as long as they can. So this, the other thing which I kind of skipped over here is what happens to the charitable lead trust? How long can it hold that S stock before making an ESBT election? Well, if it's a testamentary trust, it can hold it for 2 years. Testamentary trust just is a trust that's created under a will or under a qualified revocable trust that makes a 645 election. Now, if you have a pretty straightforward thing where you have the CLT directly funded from the estate or the qualified revocable trust, then definitely you can do it for 2 years without the ESBT election. But again, my goal is to sell the stock before it gets to the CLT, so you don't have to worry about that. But if somehow you wind up getting stuck, somehow getting that stock into the CLT, here's my other question, and I don't know the answer to it yet. I put on the AgTech listserv. I haven't gotten a response yet. I don't know whether I'll ever get a response because it's an unknown. So with this idea of the 6 years and 9 months, here's how I went through it. Again, I talked about until the 645 election expires, and then 2 years after the 645 election expires, the qualified revocable trust holds it as a testamentary trust. Then, if it still hasn't been sold yet, then by the time that 6 years and 9 months expires, you bequeath the stock to the estate, and the estate can hold the stock for as long as the estate is open. And if you have a 6166 election in place, the IRS has a revenue ruling that says that the estate can hold S stock for the entirety of the 6166 election. So we're talking about over 14 years, 14, 15 years, whatever. So the estate can hold it for a long time. And then what happens if the estate then bequeaths the stock to the charitable lead trust? Okay. And does the charitable lead trust qualify as a testamentary trust? Because you already got your first bite in this third bullet point here to having the testamentary trust. Do you get a second bite of it as a testamentary trust? I have no idea what the answer is on that. I don't think that the IRS thought about that. The idea that the downstream trust of a qualified revocable trust should be taxed as a testamentary trust, should be treated as a testamentary trust. That was an idea that I had that got integrated into ABA and I think AgTech comments to the regulations. And the IRS quickly adopted that, and they liked it so much that they made that suggestion retroactive to when Code Section 645 got enacted. And I was not at all thinking about getting this double bite at the testamentary trust apple. And I doubt the IRS was either. So I don't know if that would be abusive to take a second bite of the testamentary trust apple or not. So I can't really opine on that. All right, so let me go into some other things. And so let's talk about when you have a non-resident trust, a non-resident estate trust. So, being able to trap the money, to trap the income inside the trust is particularly helpful when you have these marketable securities. So the idea is to get the marketable securities portfolio into the S Corp. I am concerned about the exit strategy for it and the need to have these multiple trusts in order to avoid that issue. And then you also have the remaindermen getting their own separate S Corp. That's great for splitting it up. But then what happens when that remainderman then dies? And I think the answer is we can have this strategy go for 2 generations before we have to face that issue. And in the meantime, maybe we can find some kind of solution. If you have some kind of turnover at some point, then, maybe every time the S Corp, for the kids, every time the S Corp sells an asset and you're going to recognize that income, pull that out of the S corp down to the trust, and then do other things with it. And you don't have that strategy in place anymore, but at least you're not getting taxed for getting it out of the S corp. Then over time, you probably will have 100% turnover, and then you can avoid the tax on liquidation of the S corp. So that's it. We've reached the total time for this. Thank you very much for participating in the webinar. Please complete and submit the survey that we'll display at the end of the session. And I look forward to future contact with you. Take care.